13 investing blunders I see people making late in their career or in early retirement because they're chasing quick returns, chasing big gains. Okay? So I'm going to detail these 13, what I do about it, how I avoid them. The last two are really overarching principles that I think are fundamental, and every retiree needs to seriously consider these. That's as strong as I can say that. Okay. I can't give you a recommendation, can't give you advice, but the last two, very, very important. These 13 were, they're my experience. I've interacted with over 300 people as a retirement coach. Got to know them very well. I've also, I get thousands of comments, a dozen emails a week. And just I study a lot of content from magazines, books. You can imagine in my life and what I do, the topic of retirement investing always comes up. So this is my data dump to you, and do with these whatever you want. I'd love to see you score yourself between 0 and 13 on these, okay? And let me know that in the comments. If you think I'm wrong on something, especially if you think I'm wrong, leave a comment. Maybe I'll learn something, change my approach, make a new video based on your comment. Last thing I'll mention is this is my 900th video. 900. It's been a long journey. I've been making content for a little over 6 years now. Your stories and comments keep me going. Just the dialogue, helping each other. I love that. I got to be honest though, the specific comments I get the most out of are people that learn something from my channel. They tell me that they retired 1, 2, 4 years earlier than they thought was possible. One person, 4 years, 7 months earlier than they thought was possible. Didn't even think about retirement until they looked at the input that I took in and the actions that I took, what best practices I'm trying to follow, my approach, just decisions I've made along the way. Not saying I'm right, but my decisions gave them confidence to retire. That's pretty overwhelming. And I'm telling you, when one person gives me that feedback, just one person, it makes me make 10 more videos. So comments are real. Otherwise, I'm just a person alone in a room making videos, talking to a camera. Okay. So let's jump into the 13 investing blunders that I've seen. Number 1, FOMO, fear of missing out. Jumping into hot stocks or trends, buying what everybody else is buying. This is, you're going after Nvidia or gold this year. Gold is, man, everybody's advertising gold. I'm getting an email a day asking me to sponsor gold. I still don't own any directly. Maybe in some of the companies that are my funds are a part of. But the Magnificent Seven, oh, they're hot. They're hot, and they got PE ratios of 30. But jumping into those hot trends, I am a sloth investor. I don't do anything sudden and fast, okay? So FOMO is a big deal, especially, hey, I want to get to the number 1.0 million, so I'm going to, put 30% in Bitcoin and making that big bet. Good luck with that. Number 2, overweighting a single stock. This is related, but a little bit different. Putting your money, how much do you have in Bitcoin, or how much do you have in gold or Nvidia? I own 0 individual stocks right now. 0. I used to own Alcoa, AA, but that was a stock that I needed to hold for 3 years that was just part of my income. And I sold it within 6 months of when it matured. I never kept it because I learned from a company called Enron. Don't have your job and your retirement and your investments in the same company. Don't do that. Play different. Okay? So overweighting an individual stock. I know people that have talked to me that had 20% in Apple, and it's done great for them. But as you approach retirement, that's pretty risky. One news story could wipe out a lot of your net worth. Number 3, ignoring your risk tolerance, acting like you're 25. Hey, when I was 25, I was 100% invested in the stock market. And, I'm 61 now. I don't invest the same way. I've got some safety. I got some diversification. And I'll talk more about diversification here. One of the things I did when I was 25, what's interesting is you had to do this on the phone, is you could buy, I worked for Alcoa, and I was pretty good at understanding Alcoa stock. When it went down 10%, I bought it. When it went up 10%, I sold it. So I was moving my entire 401k. Remember, I didn't have much money. I was 25. I would move 100% it to Alcoa, 100% of it into an S&P 500, 100 back and forth, and there were years I made 40, 50% doing that. I don't do that anymore. I haven't done it since probably I was about 26. High risk, but it worked well for me. But I was in my 20s. Number 4, timing the market. You've heard this, trying to time the market to predict highs and lows. You're trying to maximize returns right at the very end of your career. If I can just buy the dip, invest, everything I've got in the dip, everything that I've got in safe assets in the dip, I have potential for a big return. No. Okay. Number 5, not considering sequence of return risk. You wouldn't believe the number of people in my retirement coaching days when I looked at their investments and they were 100% in stocks, equities, and they were planning on retiring in a month. They were 100% planning on, and they knew about sequence of return risk. And they were just going to make that change that, the day they retired. You need to ease into that, years ahead of time. You decide how many years. I started heading that direction at 5 years, but very slowly, okay? And I was lucky. With the way the market returned. Sequence of return, can you imagine planning on your retirement, planning everything, and then getting a 20% drop the week before you're planning on retiring? That's just playing too risky at the end of your career. Number 6, overexposure to employer stock. Can you say Enron? Okay. So many people are proud of the company they work for. I've talked to someone that had Eli Lilly stock and has done great for them. And over 50% of their income, of their assets, were in Eli Lilly. Apple is another name I hear a lot, that people just have enormous 30, 40, 50% stakes in. It's got them where they are. It's got them where they can retire early, and they want to keep riding that horse. It's time to put more safety in. So be careful late in retirement. It may work out great, may not. Do you really want to play that game? If you've already won, okay? If you already won, do you really want to play that game? Number 7, underestimating recovery time. I hear this one a lot. Okay, bear markets average 18 months. Okay, so I only have to have 18 months of safe assets to cover me for that 18 months. No. Bear markets are defined by a 20% decline. The bull markets happen after that and have to get back to new highs. That could be another 2, 3, 4 years. Okay. So you got to play the whole cycle. Be careful of just saying, oh, bear markets last 2 years. Oh, the last one in 2020 or in 2022, lasted about a year. In 2023, kind of recovered most of that. So that was very quick. Maybe that was average. But you got to protect yourself from averages. Don't use average bear markets and average return time. You need individuals. What's it going to be when you are retired? Okay. An average of, 10 bear markets may be, 2 years of the going down time. But what if, to get to that 2 years, you had a whole bunch of 1s and several 7s? Well, what if the 7 happens when 7 years of down happens when you need it to be 2? Okay, so be careful of averages and recovery time. You need the total recovery time, not just the downtime that is called the bear market. Terminology, it's important. Number 8, anchoring on past wins. Some of these overlap, but they're all a little bit different. Like, hey, I made 200% on Tesla in the last 2 years. That doesn't mean that Tesla is going to return 200% the next 2 years. And it's hard to give up on those past winners. It's hard to give up on those past winners, but you're playing a different game in retirement. Safety with growth, not growth all the time, and I can handle a down market. So past wins. I hear this a lot with Apple. That's probably the number one company I hear this with is Apple has, invested in Apple and that's got me here. A few Bitcoin, but mostly Apple. Number 9, lifestyle creep because of paper gains. Great stock market returns the last several years, and I'm starting to adjust my lifestyle. I am, because it's just been a good run, and even using the 4% rule, 5% rule, I can spend a little more money, but it's hard. But I know people that, hey, if your retirement nest egg is ballooned to 1.5 million, guys, we're at all-time stock market highs right now. It can go down 50%, and then you're at $750,000 and you've adjusted your lifestyle up. It's okay to make those purchases as long as you're doing it with cash. But if you get long-term payments, increase a mortgage, get a loan for a car, all that kind of stuff, and you lock in your lifestyle, buy a bigger house, buy 2 houses, and increase your expenses along the way, whenever that downturn eventually comes, you could be hanging out to dry. Okay. Lifestyle creep is a cautionary tale. Number 10, ignoring correlation risk. A lot of people may own, the Magnificent Seven, and they say, oh, those are 7 different companies. Technically true, but watch them all move the same. When the market goes down 50%, they all go down. Okay. So this is a reason why I add value investments. I had small cap, I have mid cap, I have international. Not to maximize growth. Again, you could say you are an idiot for investing in international. 17% of my bucket 2 equity portfolio is international. And you can say, I'm an idiot for doing that. Okay, that's fine. It's been returning quite well. I think it's like a 15% so far this year, but it's been a dog for 20 years. But the PE ratios are much more attractive, and who knows what the next 10 years are going to become. Okay, so I try to diversify: small cap, large cap, international, mid cap. Okay, I don't have REITs right now. I'm thinking about that because they're pretty discounted. Don't have any gold, don't have any Bitcoin. But be careful about being in all growth all the time. Number 11, confusing luck with skill. This is very hard not to do. A couple good trades, makes you a genius, And one of the things that you need to realize, there's something called survivor bias. And it's like, if you bought Apple, you look like a hero. If you bought Bitcoin, you look like a hero. You bought Nvidia, Tesla, you look like a hero. But there are far more people that invested in Peloton, Yahoo, Enron, WorldCom, GE, BlackBerry. Remember all those names? You're all same age as me. Those were the dynasties of the past. BlackBerry was so popular, nobody ever thought that anybody had a chance of catching up to BlackBerry until the iPhone came out, and then the BlackBerry went down the tubes. GE was the company that everybody wanted to model in the 90s, the 80s and 90s. Everybody wanted to model GE. Where are they now? So be careful. You did pick a good winner. If you picked Apple, you picked Nvidia, Amazon, any of the Meta. But I'm telling you, there's a lot of silent people out there, many more than you, probably times 1,000, that bet on some other companies. And is it luck or skill? You don't know who's going to be the winners quite often. Okay, now to the overarching principles. number 12 and 13. These are huge. Blunder number 12, maximizing your returns. In retirement, that is not the game. Not the game. It's been the game that you've been successful with, but it's not the game now. Safety with growth. I've talked a lot about that. You're not trying to maximize returns. Not. Okay? Is that clear? Number 13, the huge blunder, overarching principle. I'm passionate about this one. Going it alone. Staying in your own head. Now, I'm looking at you now. Don't roll your eyes at this one and say this isn't important. This is huge. Of the 300 clients that I worked with as a retirement coach, two gave me a retirement plan that didn't have significant opportunities for improvement in. Two. Okay, check your ego at the door. Going it alone is a huge mistake. We all have blind spots. I've got two links below, one with defining wealth and one with Donaldson Capital Management that will take your plan in whatever format it is, and they will do a review of that. They'll review it for about an hour. Then I'll have a phone call with you for about an hour and saying, here's your strengths and weaknesses. Cost you $300 for CFP. And there's not going to be a hard sales pitch at the end. They just want to do a good job, earn your trust, learn from the experience, and move on. Okay? Move on if that's what you choose to do. But going it alone is a huge mistake. Huge. Probably the biggest on this list is having your ego saying, I can do this by myself. Check out those two links. If you want a free alternative, contact the folks at Money Pickle. They're the second link below. And the Money Pickle will get on a phone with you for 45 minutes and you can ask them whatever question you want. And that's totally free. I recommend you do that. The difference between Money Pickle and Defining Wealth and Donaldson Capital Management, Money Pickle, it'll be a cold call. You're going to pick up the phone, you're going to talk to them and ask any questions you want, but they will not have prep time to review your plan. For $300, they're going to review your plan in advance and think about ideas and put them together in a cohesive, understandable format for you. So there's a difference between those options. Do both. Contact Money Pickle, contact Defining Wealth, or Donaldson Capital Management. Don't go it alone. Massive mistake. The $300, you're going to find 100 times the impact of that through insights that they're going to share with you. That's 100 times. That's just a guess. Okay, but I've not gotten any feedback that somebody didn't find at least 2 major errors, improvements in their plan. 2. The highest I've ever heard was 12. So you got them. You got the errors and oversights and misunderstandings and the opportunities. Do you want to know them? You want to know them? That's the question. Okay, how'd you score yourself? Give me your score, okay? 0 to 13 in the comments. Joe out.